Hello, my friend. I hope all is well with you and the family. So in this video, I am going to provide a few talking points around the illustrations we had prepared, and what these illustrations display are exactly what we had discussed, the different income illustrations for both you and your wife. And then I also put together just a brief performance review, as I know we did discuss the dividend rates and the net growth rate, and I just wanted to go over that again because that part can be complicated, especially with life insurance when, in my opinion, it should not be, but it is in the life insurance industry. So with that said, let's get on into it. You'll see a number of tabs in the Excel workbook. So the first tab are illustrations for your policy. Then the next two are illustrations for your wife. You'll see 5 years and also 10 years. The 5 years represents stopping funding altogether after the 5th year. I know the original plan was to fund the policy with $50,000 per year for 5 years. You've already funded 4 years, so the 5-year tab assumes one more $50K payment and nothing thereafter, whereas tab number 3 represents the same thing, but with the minimum premium paid years 6 through 10, the minimum premium of $5,000. So let's go back to tab number 1. And I'll just walk through exactly what you are looking at here. So firstly, what's highlighted in yellow represents what has already happened. So if we look at year 1, you started this policy at 45 years old, but at the end of the first year, you were 46. You started the policy back in 2017. Where does the time go? So anything that we see highlighted in yellow represents what has already happened. So you're presently in policy year 7. It does not seem like it's been that long, but it has been. And the original plan with your policy was to fund $130K per year for 5 years and then nothing thereafter. However, you still have been paying the premium thereafter of just about $13K per year, and it's looking good. So if we look at the performance, the original break-even point was projected between years 4 and 5, and it did exactly that. You're very close to year 4, and then year 5 you were positive, where your total out-of-pocket was $650,000 and your actual cash value was $656 and change, almost $657. And then you've still been paying the premium, and it's growing quite nicely. If we look at last year, for example, the beginning of the year, or the year prior, I should say, you were at 701. You paid your $13,000 premium, and then the cash value grew to 750. Now, of that growth, it's about 50 grand, a little bit less. 13,000 of it is your out-of-pocket that contributes to the growth, but then everything else is the compounding from the insurance company. So it's moving now because you did stuff it in the early years. Nice work with that, by the way. So the first illustration on the left displays what the policy looks like if you just let it sit and grow. It's based on the 2024 dividend rate of 6.1% moving forward, but this assumes you never touch it. And then to the right, we've got the different income illustrations. So per our discussion, we put together illustrations displaying income starting at age 62, 67, and also age 70. So what I solved for here was just really a level income amount. I rounded numbers down a bit just to shoot things more conservative, but a level income stream through age 100. This way we built in plenty of time. If you said, Steve, run it to 90 so I can see everything condensed by 10 years and I can get more money out, I can definitely do that. Again, it's just me running it until age 100, rounding the numbers down to shoot it more conservative. So in reality, if you wanted to pull more money out, you likely could, which is nice. So what we've got here is as follows. When we look at the income, here's what I want to highlight. This column, total funding. What this tallies up, if we look at everything through year 10, is your total out of pocket. So with the $130 per year for 5 years and then the $13K years 6 through 10, the total input, meaning your cash going into the policy, is $715,000 and change. Okay. Now, if we look down here at age 62, when you start to take income, $55K per year, what you'll notice is that the total funding column reduces by $55,000. So what I like to illustrate here is, first, if I paid in $715, do I get that back? The answer is yes. At $55K per year, it's just about age 75. So here, at 74 really, you've gotten your $715,000 back. When it begins to go into the red here, this represents how much more money you've gotten out. So call it the earnings. So really, for the first 10 plus years, you're getting your principal back. If we look at age 74, you got your $715,000 back. You still have about $1.2 million in cash and $1.8 million still in life insurance that's paid out income tax free if you were to die. You continue to pull out $55K per year. And if we look at age 90, let's look at 95. You've gotten your $715 back plus another $1.15 million. And you still have $690 left over in cash value. And if you were to pass at age 95, a death benefit is paid income tax free of just about $1 million. Now, this is, again, based on the present dividend rate. If things change, the dividend rate and such changes, these values will adjust, but we'll continue to update it every year, just like we have. But this assumes starting income at 62, then the same thing, but starting at 67. So if you defer it for several years, you're able to pull a lot more out, $73,000 per year, which you do catch up and you get a larger total dollar amount out here. And then the same thing to the far right, starting income at 70, we've got $86,000 per year coming out. Any of the scenarios will look good. You're in a good position, even if you stopped altogether now, because you stuffed it. What I mean when I say you stuffed it is you funded $130K per year for the first 5 years. The policy is set up with a 1090 split, so the premium is $13,000. It's $13,058. So at 10%, plowed the rest into PUAs, maximizing the cash value right out of the gates, and that's compounding immediately. So it looks really good from a long-term growth standpoint and being able to pull out income, which is exactly what we want to see with these particular cases. Then did the same thing for your wife. So here's the illustration where we assume funding stops altogether after 5 years, $20K per year, $26K per year, and then $31K per year. And if you added an additional $25K at $5K per year for 5 years, you'll see you're able to pull out an additional $2,000 per year from age 62 to 100, so it definitely pays off in that respect. Then $29,000 or $35,000 if you start at age 70. But overall, able to pull out a healthy amount of income. On to the performance review. What I put together here is as follows. So we had touched on this during our call last week. What's highlighted in yellow, again, represents what has already happened. But to the right of that, we've got the dividend rate. So the dividend rate represents what the dividend rate was with MassMutual for that particular year. For example, year 1, you paid in $130. Your actual cash value was just under $112. The illustrated dividend rate with the insurance company was 6.7%. However, if you pay in $130 and you've got $111 and change, that comes out to about a negative 14% return. So you took a 14% hit in the first year. In dollars, that's about $18,000. That's how much the hit is. Year 2, well, I should say that at the end of year 1, your cash value is $111 and change. You add $130 to it, it's $229 and change. Did you get your full $130 back? No. What you got back was just about $118 if we were to do the math. What you can see here is the exact loss that year, $12,000 and change. Worst years about a life insurance policy are typically the first and second. The main reason why, you may recall this, from back in the day when we went over the policy design functions, that $13,000 base premium, which you're paying each year now, in the first and second year, it does not build cash value. The reason why is because the insurance company is overcharging us for the cost of insurance up front. So that is the main reason why we're negative in the first and second year. Beginning the third year, the policy is compounding, but also you begin to get your premium payment back. This is why we see positive growth. So what I like about these performance reviews is we can see the dividend rate here. It's decreasing, but still the dividend rate does not ever reflect what our money is actually growing by. Here is your growth in percentages. This is just the net return. In the past 2 years, after you've gotten that initial lump sum in over 5 years, it's moving. And I mean, this is an effective tax-free growth rate too, provided we don't trigger a MEC or another taxable event. But it's moving now, which is fantastic. We'll continue to track it as the years pass. But you're very close to that 5% net range. And again, as the dividend updates, if you adjust your funding at all, we will see a slight adjustment there. We'll track it just like we have. But this is a good sign. Like, this is the kind of stuff that I like to see a lot, because whenever we look at whole life insurance, I'm a big believer in looking at the actual performance, strong companies that have a track record of strong real performance, because we've seen it and we're seeing that occur with your policy. You're in the 7th year, entering year 8 in June of 2024, like it's doing what we want it to do, which is fantastic. And the same is true of your wife's policy. So here, you're 4 years into it. Started in 2020 when the dividend rate was 6.2%. Similar trend in the early years when we look at the growth percentage. But as we look at things moving forward, same thing. Looks attractive long term. And this is all based on the current dividend rate moving forward. So we've got the annual rate of return, which is just the yearly return. And then also the same thing, but in dollars, which is simply what's the net dollar amount I'm receiving from the insurance company each year, which will not be the number on your annual statement regarding the dividend. We calculate this when we put these together, because your annual statement only shows the dividend, which is the surplus piece. The guaranteed piece is not included in there. I wish that it was. If you have questions on that, let me know and I can definitely talk through it with you. Then the last tab is these two combined. Here we go. So the first 3 years, you only had your policy funding $130 per year. Then years 4 and 5, you funded the $130 plus the $50 for your wife's policy. Then year 6, you paid just the minimum premium, the $13,000 and change, plus the $50 for your wife's policy. That's why you've got that 63 and change, the two numbers combined, and then just the minimum premium for you for 2 more years, and then for your wife until year 13, which is year 10 for her. She just started her policy 3 years after yours. That's why it's year 13. You can stop earlier than that, fund longer than that. You've got a lot of flexibility there, but that just takes the combined values of these two, puts everything together, which I know we had discussed during our call that your cash value is right around $1 million right now, combined values. Nice work. So you've got a nice amount of cash value there that you can use for opportunities, whether it's real estate or whatever it might be, before using it for retirement income. So for example, when you see opportunities come around and you'd like to use your policy, what we can do is model that. We can plug it right into the loan workbook we've looked at before. I can run direct loans with the insurance company's software as well. But that will allow you to see firsthand, what is my money growing by, which I have here, but then I can compare that with how much money I'm paying in loan interest and see, does it truly benefit me? Or if I take a loan and I see the cost to borrow is higher than the net growth rate, that would indicate that maybe I want to loan a little bit less to make sure I'm always in a positive situation. But it just provides transparency where we can see the numbers side by side. Let me know if you have any questions at all on this. Thank you again so much for your time last week, and have a great evening. I'll talk to you soon.
Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.